बडोदा BNP पारिबा म्युच्युअल फंड हा आपल्या बँक ऑफ बडोदा आणि युरोपच्या BNP पारिबा यांनी एकत्र येऊन भारतात चालू केलेला म्युच्युअल फंड आहे. आज आपल्यासोबत चर्चा करण्यासाठी कंपनीचे चीफ इन्व्हेस्टमेंट ऑफिसर प्रशांत पिंपळे सर आहेत. सर डेट म्युच्युअल फंडमध्ये अनेक वर्षांपासून काम करत आहेत. 23 वर्षांचा त्यांचा अनुभव आहे. सध्या ते बडोदा BNP पारिबा म्युच्युअल फंडमध्ये जवळपास 15,000 कोटींपेक्षा जास्तची रक्कम मॅनेज करत आहेत. मोठा अनुभव आणि प्रचंड नॉलेज आणि अशा गोष्टी ज्या आपल्याला सर्वसामान्य गुंतवणूकदारांना माहिती नसतात, तर अशा गोष्टी सरांनी आज आपल्याला इंटरव्ह्यूमध्ये सांगितल्यात. रिझर्व्ह बँक व्याजदर कपात कधी करेल, सध्याच्या परिस्थितीमध्ये गुंतवणूकदारांनी कोणत्या म्युच्युअल फंडमध्ये SIP करावी, त्याचबरोबर इराण-इस्रायल युद्धाचा भारतावर काय परिणाम होईल, त्याचबरोबर फंड मॅनेजर स्वतः कुठे गुंतवणूक करतात, अशा अनेक प्रश्नांचे प्रशांत पिंपळे सरांनी दिलखुलासपणे उत्तरं दिलेत. मुलाखत इंग्लिशमध्ये आहे, पण कंटेंट खूप जबरदस्त आहे. याचा नक्कीच तुम्हाला एक गुंतवणूकदार म्हणून फायदा होईल, त्यामुळे मुलाखत शेवटपर्यंत पहा. वेलकम टू वन इंडिया मराठी सर. So as I am also investor, so currently retail investors and borrowers are having one question in mind: when RBI will start rate reduction, because countries like US, Canada, Brazil have already started the rate reduction cycle. So this is the main question. Before starting, I want to introduce you to our audience. So we have Mr. Prashant Pimple sir with us. He is the Chief Investment Officer at Baroda BNP Paribas Mutual Fund, and he has a vast experience of more than 20 years in fixed income. So, welcome, sir. My first question is, when can we expect RBI to start the rate reduction cycle?
Internationally, as you rightly said, countries like a couple of countries like ECB or Bank of England or even US. In fact, last month we had US also starting to cut rates. So all these countries have started cutting rates because of the data, the inflation data out there, and the projection of that inflation data and the employment data out there. In India, yesterday we had monetary policy in which we are going near the rate cut. That's what I feel. If not now, maybe in a couple of monetary policies. Probably, I feel that the timing is fourth quarter of this financial year. That is between Jan and March. We might get or we might see a Reserve Bank of India. Going for a rate cut. Yesterday, we saw a stance change from withdrawal of accommodation to neutral, which is, I think, which also gives a lot of flexibility to Reserve Bank of India, that if inflation is near its target and growth projection is stable around 7%, still they might go for a slight rate cut getting into the next quarter.
That is indeed a good news for us. And how is it good news for investors that you are going to guide us? So my second question is, if we see the 10-year bond yield chart, it has already started declining right from 2022, second half of 2022.
Right.
And the 10-year bond yield already is down by 0.9%. We have seen similar cycle between 2013 and 2016, and again followed by 2018 to 2020. So can we see similar kind of decline, that is a 2 to 3% of decline in the bond yields? And if it happens so how do we encash this opportunity through fixed income instruments?
See, one thing is there, how do investors get an opportunity, or when they will judge that the rates will start going down? But interest rate don't wait for Reserve Bank of India to actually cut rates and then move. Not majority, but considerable portion of the move, as far as your long bonds goes, they are already discounting the future rate cuts what Reserve Bank of India will do. I told last question that already Reserve Bank of India has infused a lot of liquidity over last couple of months. Over and above that, they have also changed the stance from withdrawal of accommodation to neutral. That means they will keep liquidity very, very stable. Once the liquidity becomes stable in the system, that is when they go for a big move on the rate cut. But market doesn't wait for the actual move to happen. They already start discounting that, and that's the reason over last couple of months, or say maybe 1 year or more, you would have seen gradually the interest rates coming down. Typically
Correct.
interest rate move in a fashion that, okay, you are coming near the end of interest rate cycle, so over a period of time you will have rate cuts, so people slowly and steadily start buying. Okay, over and above that, we had a couple of good news like JP Morgan bond inclusion, which will bring up the demand of almost 20 to 25 billion US dollar. Recently, we had FITSE, where the amount is small, but still it's a good news because a lot of international investors are looking at India as an opportunity. Probably in next calendar year, beginning of next calendar year, we might see one more index, the Bloomberg index, including Indian bonds into the emerging market. So that will create an automatic demand. So it is not only investors like you and me, or your institutional investors in India, domestic institutional investor. These are also foreign portfolio investors who are much interested into Indian markets. So I would not say that. I mean, last 1 year yield have come down, so it will not move further. We are close to around 675, 680, with overnight say around 6.5. So if we are anticipating that over next 1 year or so, we might get 75 to 100 basis point of rate cut, then we have much more scope of yields going down, and accordingly investor making money, be it a normal or a plain vanilla product where majority of our investors, retail investors, invest like a fixed deposit, which is not a mutual fund product, but I'm saying from a product perspective, be it a fixed deposit of a corporate, or of a bank, they will lock into rates. But if they want liquidity, and if they time the interest rates going down in a proper way, the best product for a lot of investors would be that which gives some duration to them, so that when the product gets mark to market, or when the yields which are coming down has an impact on those products, the return enhances as compared to other fixed product, which will give return over say a period of time where you are locking in. But here I think in short to medium term, there is a probability that over next 6 to 12 months you will get a really attractive return. Just to give you some perspective, as you said that yields are down by 70 to 90 basis point over last 1.5 year. I think you are talking about 10 year from top to current level where it is. So in this move, last 1 year itself, we have seen close to 9 to 10% return being generated into say medium to long duration funds. So that's an indication for us as to how, what kind of returns one can get over next 6 to 12 months into such products.
Your guild fund has also performed very well.
Yeah,
So the government bonds are likely to benefit because of this down move. Unfortunately, I also meet many investors, but especially the newcomers, they think that mutual funds means only equity. They are not aware of the very big opportunity which is called as debt or fixed income. So either the investors put their money in fixed deposits, or if they come to mutual funds, then flexi cap and small cap and mid cap. This is
right.
the flavor of the market. So can you tell some advantages of debt funds or fixed deposits so that our investors can think of that option?
So obviously, I mean, last couple of years, equity have been giving a fabulous return. So obviously, anyone would say that, okay, in equity, I get so much return. Why should I invest there? But I always believe I'm in this industry for last 20 years, and there are a lot of seniors in this industry who are talking about asset allocation. Because see, what happens is over the years, the profile or the demographic of the investor also changes. The risk profile also changes over a period of time depending upon what stage of life he is, what stage of responsibility he is. I'm talking mainly about retail investors. So, a retail investors, they have to believe in asset allocation. the asset allocation in debt can be 50% or maybe more than that, depending on the situation, or it can be more in equity depending on the situation. So probably when you judge that, okay, going ahead, what kind of a situation I will be into, and accordingly I have to shift the allocation from one asset class to other asset class. And when I mean other asset classes, I also mean that people do allocate good amount of money or some allocation into real estate, into gold, into fixed income, into equities and other asset classes where they understand the risk involved in it. So all these asset class, mainly retail investors understand the risk involved in it, and every asset class has an opportunity over the years. And that's what I told in the previous question, that okay, over next 6 to 12 months, last 6 months we have already seen, over next 6 to 12 months also, there is an opportunity where RBI will start cutting rates. When the overnight goes down, your US, BOE, ECB will also cut rates. In that scenario, entire yield will start moving down. There will be additional demand from foreign portfolio investors along with domestic investors also. So all these factors are positive, along with the CPI, what Reserve Bank of India declares, and the growth estimates, what Reserve Bank of India has declared yesterday. All these things are really, really positive if we look at the market from a forward-looking perspective. And hence, I feel that there has to be a reasonable allocation to debt also over next 6 to 12 months, wherein you have a possibility of getting good returns. In fact, what we have seen what good returns means as far as debt is concerned over last 1 year, with say 50-60 basis point of down move on the 10-year GSEC. So if over next 1 year there is a 100 basis point cut and we see a good amount of move on the 10-year itself, then mid to long duration funds obviously will give you good returns over a period of time. And hence, I think investors should think about giving a reasonable allocation to this asset class also, along with other asset classes where they have a view. Say if someone is interested in gold, he can give allocation to gold. Someone is interested in equity, he can give reasonable allocation to equity. But yes, there is an opportunity on the debt side which is reasonably stable as compared to many other asset class, which goes up and move down in a very big band. But when you come to debt, the movement is quite limited and in a particular band. And hence, I feel that the allocation might shift. So I cannot tell anyone that you do 50% or 60% allocation to debt, but I can certainly say that one can analyze their own situation, what life stage they are, and accordingly allocate that money to debt.
So I would like to share one interesting finding. I was doing a research a few months ago. So as I said, the 2013 to 2016 was a cycle of downfall in the bond yields, and similar was the case in 2018 to 2020. In both the cases, actually the long duration funds outperformed the Nifty. So considering the, as you said, considering the risk reward, investors should definitely this kind of funds, especially when the equity is richly priced. My next question is regarding like many experts were expecting a rate reduction in the MPC meeting, which happened right now. So, but unfortunately, prior to that, Iran-Israel war started. So, the crude which was trading at $70 has risen to $77. So, Iran-Israel, is this the reason why RBI has postponed the rate cut, and what impact it can have on the bond yields?
No, certainly not. The geopolitical reason is not the only reason why Reserve Bank of India has not given a rate cut yesterday. It was very well, though, in the retail segment or outside the investor segment, people would have expected. But As far as normally institutions like mutual fund or any other financial institution goes, the expectation was that there will be something on the liquidity front and stance front, and no one was expecting, or very less number of people were expecting, there will be kind of rate cut. So what Reserve Bank of India has done is totally in line with the expectation of what the market was expecting. Over and above that, when the rate hikes were happening, just go a couple of years back, when the rate hikes were happening, at that point in time where other developed markets hiked rates by 450 to 500 basis point, that is 4% to 5%, India hiked rate by 2.5%. So there is also a gap when the rate hike happened. So when the rate cut happens, we cannot expect that our rate cut will be equal to the rate cuts of developed economies. So there will be some gap between their timing of rate cut and our timing of rate cut, because the situation in our country and other countries matters a lot. And as far as the trend of Indian Reserve Bank of India goes, first they will always act on liquidity, make the conditions stable, and then they will go for rate cut. As far as Iran-Israel war impact on the market goes, yes, certainly these are geopolitical things. Taking view is very, very difficult. But the way things have been panning out, uh, even before, say, even in case of Russia-Ukraine war, or the initial stages of Israel war with various countries and all, we have not seen that kind of volatility, which is actually impacting our crude and other commodities market. One important factor for that is also Chinese economy, which is not doing as good as we were seeing couple of years back, where the commodity prices, including crude, was going up, because China is a reasonably big economy where the demand for global commodity also increases when it does well. So when it is not doing well, the demand also decreases, and that also has impact on your crude oil prices amongst all the commodities. The third factor is what percentage of your imports, your country imports, and the country's overall import of crude happens from, say, mainly Iran, because that's a oil reserve. The rest of the countries are not that much into oil reserves. So even if one oil supply disruption we have to talk, I think if I remember correctly, it's roughly, say, 12 to 13% of the overall world supply, which is, I'm not saying it's a small amount, it's a reasonable amount, but at the same time, that can be very well compensated through the oil reserves of other oil exporting countries over a period of time. The main impact which comes is because of the logistics issue on the oil front or any commodities front, which happens because of the Middle East war. So that is the factor one has to consider, because tomorrow there might be an escalation from Israel on Iran and other countries also. We really don't know. So that factor always has to be at the back of our mind before giving allocation to any asset classes. But still, in such asset classes, people, whenever there is an escalation, people go for safe asset classes like precious metals, or even sovereigns for that matter, say Japanese sovereign yield curve, or your Switzerland sovereign yield curve, or your US sovereign yield curve. So that impact also eventually comes on to our fixed income market.
Yeah, got it. So let's hope that this issue gets resolved very soon and it does not have a negative impact on India and Indian bond market. Uh, right now, say for example, I have a certain amount, say a 10,000 rupee SIP or lump sum, some kind of amount, and I have a time horizon of 3 to 5 years. I want to invest purely into debt. So, what kind of funds shall I select? Because we have a number of options in debt also now. Investors get confused.
Right.
What kind of funds we should select? Dynamic, long duration, yield. So, how shall I divide the amount?
So if you have a horizon of 3 to 5 years, and you want to stay invested, or currently there are no tax benefits attached to, even if you remove after 1 year, and put into other asset class, I think that's perfectly okay. So one can currently, if someone has to invest now, I think he should look at funds like, say, your dynamic bond fund or gilt fund or your long duration funds, where he can invest money comfortably for next 1.5 year. Maybe post that, whenever the 10-year comes to say around below 6% and all, one can become a bit cautious and allocate the same money into say short term funds. So one of the best strategy is, if you don't have to move your fund from any of the product, then you can comfortably park your money into say a dynamic bond fund, which runs say 8 plus kind of duration right now when the yields are in favor. And when your yields are not so attractive, it will reduce the duration to even 2.5, 3, where the short term fund lies. And that's how it saves on your timing of, it does the timing which you normally do. So I would recommend that someone who has a 3 to 5 years horizon, he should look at dynamic bond fund. Someone who has a 1.5 year horizon, he should look at gilt and your long duration funds also. And someone who is consistently looking at a stable return, say of around 7 to 8%, which typically is given by, say, a short term fund category, you can look at short term fund category, stay invested for say 3 to 5 years, and stay put into these kind of funds. So I will just give you one example how these opportunities help in garnering returns into long duration funds like gilt fund. Like gilt fund last 15 to 20 years, CAGR is more than 9% on a net basis, which is, I'm not saying it is very attractive or it is very dull, but looking at a fixed income arena, a sovereign arena, I think this is a attractive, good return which a person can expect from a fixed income market.
So you are doing a good job. You are managing a big amount of money. So that is our retail investors' money. But we have curiosity that where do fund managers invest? So what is your favorite asset class? What are your investment preferences?
See, most of our asset class are basically mandated to us by our regulator. So
Okay.
when I'm managing my fixed income portfolio, I mean the mandate which is given to me, I have a limited asset class where I can invest, say, sovereign, corporate bond, and obviously the new asset class which we are giving allocation to is REIT InvIT into our funds and some variations into this fund. This is as far as my professional investment goes. As far as my personal investment goes, clearly I'm, as I told you in the very beginning, I'm allocating between debt, gold, real estate, and equity depending upon my risk profile. So
Okay.
it can be different percentages. I review it every quarter and decide on the percentages and allocate as per the opportunity. And it is, return is always not my primary decision of allocating money. Basically, need of liquidity at any point in time and need of my capital preservation decides my asset allocation over a period of time. So if it's a very long period, then certainly I will look at gold, real estate, equity. If it's a period of say 1 to 3 years or 5 years, I will certainly look at allocating a decent amount into fixed income also.
So basically, I have been tracking many AMCs, and Baroda BNP is definitely uh, doing a good job. So your balance advantage fund, guild fund, and dynamic bond fund. I had an opportunity to meet Sanjay Chawla sir also.
Okay.
So I wish you all the best, and thank you for your time for One India audience, and we look forward to such kind of insightful interactions with you.
Thanks a lot, Mr. Kulkarni. Thank you very much to you and your team. Thank you.
Yes. Thank you, sir.